Welcome to REChat, where we talk about anything and everything about real estate. Today, I would like to share with you some strategies that you could use in today's housing market. The first strategy I'd like to share with you is called the seller financing. So traditionally, usually it's you promise to pay the bank, and the bank will give the cash to seller, and the seller will transfer the housing title to you. So that's the very traditional financing process. However, with the seller financing, it's completely different. It is much more flexible and much more accommodating, and also is cost effective. There's no mortgage insurance, and there's no very strict credit requirements, like you have to have a credit score above 700. No, the seller is actually more flexible with that. And of course, they don't need mortgage insurance because the seller, they usually actually hold the property as the collateral. So they don't really need mortgage insurance. And on top of that, because the seller, most of the times they're motivated to sell, so they can offer the buyer much lower interest rate than the market rate. So with that being said, I think seller financing is much more attractive than the traditional financing, if that's a big if, capitalized IF, because that's only if the seller is willing. And a lot of times, because the seller, they only wanted to do this as sort of almost like a bridge loan. So basically just to bridge the gap between, now you're buying the property until you can get another like a financing from another lender. So that's why it's a short-term bridge loan, so to speak. So usually the term is only 3 months, 6 months, usually not more than 12 months. And so whether or not you want to renew it, you have to negotiate with the seller again, or you can sign a contract with the seller ahead of time. So about just to make sure you put it down in black and white in writing, and how you wanted to put have the renewal options, like say renew another 12 months or 6 months or 3 months at what interest rate. So that's something, if you want to have a peace of mind, you can always negotiate with the seller ahead of time. And also one thing to keep in mind is that even if the seller, some seller, they're willing to offer you seller financing, but they're not always all sellers are able to do that, because they have to make sure they have no outstanding mortgage on their existing home. So that's why not all sellers even qualify to offer you seller financing, unless they don't have any loans on their house, or they can pay off their loan first and then provide you with the seller financing. So that's why the opportunity is very, very limited. But if you come across a seller who has the qualification, or who is qualified to do so, at the same time the seller is waiting to do so, believe me, that's a great opportunity to negotiate with the seller for seller financing, and with all the favorable terms for you as a buyer. Speaking how rare it is for the seller to provide seller financing, I do have a special offer to share with you here. One of my clients who has a larger real estate portfolio and would like to sell off part of his holdings because he wants to refocus his investment to some other bigger projects. So what I'd like to share with you, the detail here is, first of all, you don't have to put down a large sum of money, especially for foreign buyers. You only have to put down 25 to 30%. For foreign buyers especially, they have to put down 35 to 40%. 25 to 30% is really, the minimum, I would say. And also the special perks is the interest rate. The seller is willing to offer you 5% interest rate instead of 7%, 8%. And for foreign buyers, usually it's 9% or 10% plus. So this is definitely a steal. And the term for the seller financing is up to 12 months. However, with option to renew. So that gives you a lot more flexibility in terms of what options, and we can always negotiate, right? So you can actually negotiate with the seller directly and how much longer you want to renew and at what interest rate. And the best part about this is that it can be interest rate only, which means that the interest only, you don't have to pay principal. If you are at the point that you have tight cash flow and you need to get caught up with your income and etc. So this way you can just pay the interest until you feel comfortable to pay interest plus principal. Again, here's the quick disclaimer. This offer is only limited to selected residential and commercial real estate properties exclusively provided by our client and also listed by Synergy Realty International. So if you're interested, you can contact me for details. The second strategy I would like to share with you today is called the lease with right to buy. So why this options is really good, attractive? Because as a buyer, if you're not quite ready, this can give some time to get ready. So what I mean, when you're not ready, usually it means that you have not saved up enough down payment, or the interest rate is so high and you're not quite ready to make the purchase yet. So you can actually negotiate with the landlord / seller and say, hey, can I sign the leasing agreement with you with rights to buy? So this way, again, like I said, you have option to save up more down payment or be qualified for better loans. At the same time, you can wait for the interest rate to come down because nobody wants to buy right now, right? 8-9%, and then maybe even worse for foreign buyers. So you can wait until the interest rate comes down, then you can go ahead and make the purchase. That's why you have the right to buy. You don't have to, basically, if you're not quite ready, you don't have to buy, only when you are ready. And also here saying that when you sign the lease agreement and you can stay in this property until you're ready to move, because you don't have to move, right? Once the lease expiration is there, it's due, and you don't have to move. So you don't have to scramble and then find another rental property to move to. And at that point, you can say, hey, you know what? Maybe now I'm ready to make the purchase. But that's from the buyer's perspective. On the contrary, from the seller's perspective, why the seller is willing to offer the tenant a lease with the right to buy? And I think the pretty obvious reason is that because the landlord can make extra money, right? Or slash seller can make extra money. So the seller basically say, hey, you know, I can charge a premium rent. I can charge a premium rent for like on a monthly basis or annual basis. You know, just the premium can be treated as sort of like the price the tenant has to pay or the buyer has to pay in order to have the right to purchase. Just look at this like a stock. Like stock, you have a call option, you have buy option, right? The call option gave you the right to buy, and the put option gave you the right to sell the stock. So you don't get this call or put option for free. So you have to pay a call or put option premium. You know, it could be $5, could be $10. And then when it applies to lease with the right to buy, so basically the rent will have a premium above the standard rent. Like just to give you an example, let's say if the rent is $5,000, the landlord might charge you, let's say $6,000 or maybe $5,500. That's something you have to discuss or negotiate with the seller slash landlord to see how much they're willing to give you the lease with option or lease with the right to buy, how much for that option or right? So it could be $500, could be $1,000, could be more, could be less. That's all negotiable. However, from the seller's perspective, they make extra few bucks, and then, you know, why not? They're happy. And also at the same time, if they really have the intention to sell, they say, you know, if I have a tenant stay in my property as a tenant slash potential buyer, they will have they will be more responsible to take care of the property. Oftentimes, the seller will have the tenant slash buyer to basically maintain the house. For example, fix the plumbing issues or pipe or wire, whatever it is, because the tenant is interested in buying the property. So that's why the landlord has less maintenance issues to worry about, and they have less things to have to do for them, you know, on their own, right? And then also on top of that, the tenant or slash buyer will be more responsible. What I mean by more responsible, that will take a good care of the property. They will maybe even repair the property to the way they like, because they will buy this property. The third strategy I would like to share with you today is called the leaseback post-sale. So why this strategy is very attractive, especially to sellers, because seller, they have time to either rent or buy next property. So they don't have to rush. You know, if they have to move out right after selling their property, they have to find a place to live right away, right? Or ahead of time. But if they don't want to buy or rent until they know for sure they're going to close escrow on their existing home. So that's why there's too many, like say, uncertainty and the factors in the whole equation. So that's why a lot of times the seller, they're a little bit hesitant to sell if they don't really know if they're going to have a place to live. But if you offer the seller a leaseback post-sale, basically the seller will have a peace of mind. They say, first of all, they already have the cash in hand, right? They already sold the property, closed escrow. They already have the money in hand. They will be able to either make the next purchase or rent a property. So this way they have a peace of mind with that. At the same time, give them some time to find the next property, either to buy or to rent. So this way, give them a very, very easy and, carefree, so to speak, almost, transition, so to speak. And then, so when they actually get ready, so we say, okay, so I might need a 3 month, I might need 6 months, depends how much time they will need. Of course, usually the leaseback post-sale is no longer than 6 months. I would say most common period will be like 3 months or so, depends on the seller's situation. But I think if you can offer this to the seller, or seller can request for this from the buyer, and this will make it really a happy, I would say, the happy solution to both parties. So definitely look into leaseback post-sale option, and when you actually in the process either buy or sell. Speaking of the leaseback post-sale, here I would like to share with you a quick checklist that you could use when you are in the middle of the negotiation. Doesn't matter if you're a seller or buyer, I would suggest you going through this checklist. Believe me, it will be very beneficial and it will be very helpful and it help you to avoid some pitfalls. The first one is pretty normal, standard, like rent, right? The rent between buyer and seller, which will become a new owner and the new tenant. So how you wanted to figure out what's the amount, right amount, appropriate amount for the new tenant to pay the new owner. So really it depends on the situation, right? So it could be zero, could be a market rate, could be market rate plus a premium. So it really depends on the specific situation, negotiation between two agents representing two parties. But I would say the most common one is really based on the PITI, is really a fair amount. What is a PITI? Is a combination of principal, which is we know that when you pay a loan, right, pay a mortgage, that's the principal amount, plus the interest, plus the tax, property tax, plus the insurance. So PITI is pretty a fair amount for you to settle, sort of like to be fair to both parties. And there's also HOA association fee, but I didn't add here because association is really optional, not an option, I should say. It really depends on the community. You might buy a property, the property might be in the community that has association, might be in the community that there's no association. So that's something, it really depends on the situation itself. But normally is a paid association fee is paid by the new owner, which is the buyer, right? So those two, the PITI and the rent amount, is very common negotiation between parties. However, there's three other items that I would like to remind you, because most of the time the buyer and seller, they're not aware, or they don't pay much attention to, and even their agents actually overlook them. So the first one is a security deposit. And so a lot of times, oftentimes, and so the buyer, they say, they just collect the rent. They didn't realize. And then so there's a 3-month, maybe 6-month, that's the lease terms. Upon the expiration of the lease term, and it's also up to the buyer, which is the new owner, to actually do the home inspection, right? To say whether or not this property is still in good condition. If not, then what do you do? If you don't have a security deposit being held, and oftentimes, even they negotiate for the security deposit, a lot of times the security deposit is held in escrow. And if I were a buyer's agent, I would not want the security deposit to be held in escrow. I would definitely want a security deposit to be transferred to the new owner, just because if it's held in escrow, still that's going to be difficult if you need some money to do the repairing as a sort of a reimbursement for the repairing. It's going to be much more difficult. So definitely, in order for the buyer / new owner to have 100% control, it's always good to have the security deposit to be transferred into your own account before closing escrow. And the next one is renter insurance. And because now it becomes a rental property, even though it's a short term, but you still should not overlook this. You should still have the seller / now new tenant to actually obtain renter insurance, because your home insurance that you have will not cover renter's insurance. Because a lot, especially if you apply for a mortgage, apply for a loan, so the lender it's making it mandatory. You as a new buyer, you will have to get home insurance, right? Unless you pay with cash, that's not a requirement. But even that, you still should get a home insurance. But home insurance is different from renter's insurance. So when it comes, like let's say some bad thing happened, basically home insurance is not going to be able to cover the damage when the actual property, technically speaking, becomes a rental property, and then you have the tenant staying in the house. So that's why it's always safe, and just to give yourself a peace of mind, to have a renter insurance. And the lastly is called the daily holdover rate. Daily holdover rate, this really, I would say almost 99% of time is actually being overlooked by the buyer, seller, owner, and tenant, and even agents, because you want to make sure the tenant or the / seller would not stay in the property longer than necessary or longer than agreed, because a lot of times, you don't know whether or not the seller or / tenant is actually ready to move out, or they find a new home to buy, or they find a new property to rent, you don't know when exactly that happened. So might be they need more time and then they want to renegotiate a term, or they just stay there, not moving out. Then you're stuck. So it's always good just to kind of give you another layer of protection to have daily holdover rate. Basically, you can assess the rate. I mean, that's something you can, again, negotiate between parties, right? But I would say, let's just say, throw out the number, $500 per day. If the tenant / seller stay in the property, becomes your own property longer than agreed to, and that you don't want to renew, and you can basically just have them move out. If they refuse to move out, you can say apply $500 or $800 per day, depends on the property size and etc. Just to basically as almost like a per diem, just as a compensation to you, so you don't let them stay there for free. So that's give you buyer / new owner another layer of protection. So this way you have a better peace of mind that are going into this seller leaseback post sale. The last strategy I would like to share with you today is called the seller credit. It's perfect when it's perfect for you to use when it's a buyer's market or in a high interest rate environment. So how you can use this to basically for the seller's benefit is to actually entice the buyer to basically move forward to purchase the property, right? So basically the seller can offer seller credit to help the buyer to offset some of the cost of repairing. For example, from the home inspection report, there's a list of the items that needs to be repaired or replaced. So the seller can offer the seller credit to make the buyers more inclined to purchase the property. And also the seller can give the credit some cash back, to help the buyer to settle down, buy furniture, because furniture does cost money, and especially now the furniture is very expensive. So if the seller can offer some cash to the buyer, especially the buyer has drained most of the cash to buy this property, so that really can basically entice the buyer to move forward as well. Another one is because the seller can offer cash to help buyer to buy down the mortgage points. So it costs money to reduce the mortgage interest rate. So if the seller can offer some cash to help the buyer to buy down the mortgage points to reduce the interest rate, that would be really, I would say, really something to cheer them up and then, get them to move forward with the purchase as well. So that's definitely, something to help to encourage the buyer to make the move. And the last one is a little bit more complicated. It's basically the seller can offer seller credit to lump the closing cost into the buyer's mortgage. And I know it's kind of not easy to quite follow what this means, but what I can do is I can give a real example or give example. And so this way you can see how the number works and, see how this can really help the buyer to make the purchase when the buyer has very tight cash reserve. They don't have enough cash to make the purchase. We just talked about how seller can use the seller credit to help the buyer with the closing cost. And it's difficult to just understand superficially from what I just told you, but let me show you the numbers. So let's say, here's the example. Have a house, the sale price is $500,000. So down payment is 20% of $500,000. So the buyer needs to put down $100,000. And the closing cost typically is 3% of sale price. Let's just say here, 3%. So the closing cost for the buyer is $15,000. So let's just say without seller credit, and so the buyer, how much the buyer needs to put out upfront. In other words, what's the buyer's upfront cost? So basically, buyer has to put down payment, which is $100,000, right? 20% of $500,000 plus the second is closing cost, which is 3% of the purchase price, which is $15,000. So add them together. So the buyer's upfront cost is $115,000. What if the buyer basically say, you know what, I'd love to buy your house, but I just don't have that much cash. So how can the seller to help out the buyer without really paying any money in a way? So here's the solution. So the seller can give the buyer $15,000 seller credit towards closing cost, and then at the same time increase the sale price by $15,000. So in another word, basically the seller has nothing to lose. It's kind of like cancel each other out. Is a wash for the seller, right? The seller gave the buyer $15,000 seller credit towards closing cost, and the seller increased the sale price by the same amount. So basically, the seller has nothing to lose. However, it makes big difference to the buyer. Now the new buyer's upfront cost becomes $103,000 for the down payment, because now the sale price is $515,000 and 20% of that is $103,000, right? Then the closing cost also has been adjusted up, because now the 3% of $515,000 new purchase price becomes $15,450. So that's the new closing cost. And then because has to seller credit, right? Because the buyer received $15,000 from the seller credit. So minus $15,000 seller credit. So the new buyer upfront cost becomes $103,450. So that's actually less than $115,000. And the saving to the buyer is $15,550. That's pure saving, upfront saving to the buyer. So this way, the seller can complete the transaction by helping the buyer. And the buyer doesn't have to put out as much money if they don't have that much. So this way, they can make the purchase without having to borrow money from somebody else or, take other, credit if they can find any. So this way, it can really make the sale process much more smoother and the transition is much easier. However, the prerequisite is that the $515,000 new sale price, can be appraised at this value or above by the lender, right? Because that's important. And also the buyer is qualified for the increased new sale price. So that's the two key prerequisites for this to happen. But the number speaks for itself. So you can go through the number and see that how it might work. And for your case as a seller, or maybe for your buyer, if you don't have enough cash, wants to buy something, this you can bring to your to the seller and to see if they can help you out, make it a win-win. We will share more market updates or real estate tips in our next episode. Thank you again for watching. If you liked our content, please make sure to like and subscribe, and we will see you next time.